If you bought silver today at $87, we need to have a very specific chat. Not the folks who bought at $25 and are now sitting pretty with 250% gains, nor the ones who just shoveled bars into a safe and couldn't care less about daily price noise. I'm talking to you. The poor soul who saw silver jump 6% on a Trump tariff tweet, freaked out, opened your broker app, and slammed the buy button near today's peak of $87.48. Maybe you grabbed SLV shares, maybe futures contracts, or ordered physical silver at spot plus a premium. Whatever it was, you bought at the highest silver has traded since that January spike to 120, which then spectacularly crashed 31% in one day. Now, I'm not here to call your move dumb. In fact, silver powdering 87 with Indian prices at 101, Shanghai steady around 97 to 99, and Chinese exchange inventories down 91%, plus the worst trade war escalation in years, could make it look downright bargain basement in a few months. But before you throw more money at this, you absolutely need to hear this. The next 48 hours have very real risks that could whack your $87 entry by 10 to 20%, thanks to mechanical market forces, not fundamental silver stuff. Ignore this, and your brilliant entry could turn into a short-term disaster that forces you out before the bigger story even starts. Let's talk about what historically happens after these crazy 5% plus one-day surges in silver, because this isn't the first rodeo. Over the past 14 months, these surges showed a 67% chance of a next-day drop, averaging 3.8%, and only a 33% chance of climbing further by about 2.1%. So if you bought at the peak today, statistically, expect a loss tomorrow, not a gain. Why? Because these surges attract the last-minute momentum chasers who pile in late and push prices to daily highs that aren't really sustainable without fresh buyers the next day. Then comes profit-taking, the bid gets thin, and boom, your stop-loss probably gets tested before the day's out. At 87, a typical 3.8% drop means silver at about $83.70, translating to an uncomfortable $3.30 loss per ounce. For 100 ounces, that's $330 gone on paper within 24 hours. For a 5,000-ounce futures contract, $1,625 mark-to-market loss overnight. With margin accounts around $23,000, that eats up roughly 72% of maintenance margin in one shot. No, this doesn't mean silver is doomed. It's just the market doing its usual catch-your-breath dance after a sprint. What's worse, CME is poised to hike margins again. Your costs could jump from $23,000 to nearly $39,000 per contract next Tuesday. Added leverage at 87 right before that could force ugly forced liquidations. That's the danger zone. Now physical silver buyers at 87, you're lucky. No margin calls, no broker chopping positions overnight. Your metal is your metal. But even you need to think twice before adding more at this level, because piling more on jumps your average buy price much higher and means bigger swings for your stack. If you're holding SLV, that's a different story. SLV tracks COMEX prices which could drop under margin pressure even while physical silver stays higher elsewhere, meaning your shares might lag behind what your metal inside is actually worth. PSLV, you pay a premium for that convenience and security, so factor in that your 87 might actually be closer to $89.60 if shares were trading a 3% premium during the rally. If you loaded up futures at $87, congratulations on taking on the riskiest version of silver ownership. With 67% odds of a next-day dip and margin hike risks looming, you better know your equity, total margin, and how a potential 68% margin increase fits into your account. If you can't cover a margin hike comfortably, you might be asking your broker to liquidate your positions at the worst possible moment. Spoiler, that's not fun. And yes, I get it. Your brain is chemically wired to make you buy more after a 6% surge. Dopamine says, chase that sweet, sweet upside. Fear of missing out feels like a lion on your tail. Confirmation bias filters out anything threatening to your $87 buy-in. None of that is you messing up. It's just biology. That's why you need to pause, breathe, and listen to the data, not your hormones. Here's the bottom line. Don't add more in the first 24 hours. The odds favor a pullback, and waiting won't cost you much if silver keeps climbing. If CME does hike margins Tuesday, prices might fall, giving you a better entry around $83 to $84. If they don't, then you have a smoother path to higher prices and lower mechanical risks. Adding on a dip, not on the highs, is the smart move. Your $87 entry isn't terrible, not by a long shot. Fundamentals still paint it as cheap relative to physical markets where silver is trading 11% to 16% higher. Over 6 to 12 months, this could be a once-in-a-decade buy. But over the next 48 hours, you're playing a different, less glamorous game of risk management. You can be right long-term and still get wiped out short-term if you're leveraged and caught off guard. So before you add a single new dollar, wait at least a day, check for forestalling margin hikes, tally your total silver exposure, and know your average cost. Decide if you're playing short-term to $100 or holding for $150 plus. And please, keep some cash in your pocket. Going full all-in at $87 with zero reserves is how accounts get vaporized in rally and crash cycles. Silver's roller coaster will keep twisting. Your job is to survive the bumps while staying on for the ride up. It's not glamorous advice, but it's what keeps you in the game when everyone else gets tossed off.